Good morning, everyone, and thank you for dialing into our Tax Matters monthly webinar. So the aim of these webinars is to give you a brief overview of what we see as the significant issues and announcements that have been happening in the GCC. So we cover all the GCC countries for tax and VAT. These webinars supplements our tax flash emails, which we send out every Thursday afternoon. If you're not already on the tax flash list, send us an email, vat@keypoint.com or any of the VAT team, the tax team, and we can add you to that mailing list. That comes out every Thursday. Your presenters today will be myself, Mark Gamble. I head the indirect tax practice in Keypoint. I'm joined by a couple of managers from our team, Dinesh Ravi, a manager in our tax team, and Tariq Haq, a manager in our VAT team. We'll be assisted by our panelist, Adil Fawzi, a manager in our tax team. We want to keep our webinars as interactive as possible. We're only here for max 45 minutes, maybe closer to half an hour, just kind of cramming in the really important points. But we want to keep it interactive, and that means having a conversation, answering any questions you have. So please, we really, really do encourage questions. You can ask questions throughout the webinar using the Q&A widget on your Zoom function. I think it's at the top of the screen. You can ask them anonymously as well. So we're happy to answer whatever questions you have. We'll either answer throughout the webinar or save them to the end to discuss. But if we don't get a chance to answer your question, we will send you an email along with the slides probably by tomorrow with the answers to all of the questions. So yeah, please use this as an opportunity to ask whatever questions you have. Now I'll pass over to Tariq, who will start talking a bit about Saudi Arabia.
Thanks, Mark, and hello to everyone dialing in today. The Gazette released an e-commerce guideline last week in Arabic. It targets those operating through social media messaging apps online, reminding them of the requirement to register for that. What we found is sometimes what happens is a person inadvertently generates income regularly without an intention of really doing business. However, from a VAT perspective, it's sometimes sufficient for their activity to be viewed as doing economic activity and thus potentially creating a VAT registration obligation. So that's something to be careful about. With non-residents that incurred VAT in Saudi during 2020 should review their eligibility to claim a VAT refund incurred in Saudi Arabia during the calendar year 2020. The deadline to apply is 30 June 2021, which is about 4 months away. But it's a good idea to get started right away, as the documentation collection often takes several months. There's currently no formal process, but we still recommend a protective claim should be submitted in any case. A bit about Gazette, ongoing audits. Gazette's pretty much carrying out non-stop inspections of businesses to identify non-compliance with tax obligations. Every week, the Gazette releases the number of inspections and tax violations they've found. With the passage of time, obviously, we expect it to increase as the Gazette gets better at identifying issues and they look to target specific industries where they assess the risk as higher than they would like. Generally, the Gazette is carrying out between 3,000 and 6,000 inspections on a weekly basis. Out of these inspections, they normally find about 300, 400, 500 tax violations. So that's just something to take into consideration.
Thanks, Tariq. So Gazette has also made some updates to their website to include some more information around the new e-invoicing rules. So they've released updates on the regulations as well as a guideline which goes into a bit of depth about the rules, and also a pretty useful set of frequently asked questions. Look, e-invoicing is going to be something that I think is going to change how businesses operate in Saudi Arabia. And look, if you haven't looked at it now, you really should. It's going to be a big change for businesses, basically moving away from any form of paper invoicing and making sure that the data is tracked between the supplier and the customer. And that's phase one. Phase two is then linking your system up with Gazette itself. So eventually, and this is not by the end of this year or anything, but maybe in the next couple of years, Gazette will actually link into your ERP system to access the invoices you have, the transactions. So I guess they'd be conducting an audit based on your raw data, let alone what they currently do. So it's going to be a big change for everyone. And the sooner you look at it, if you're operating in Saudi, the better. If you're not in Saudi, then it's still something to look at, because Bahrain, UAE, they'll all follow Saudi eventually, and e-invoicing is just going to be a matter of the way of the future, I think. Regarding taxpayers visiting Gazette offices, so more of an admin point, you need to download an app now to actually enter the offices for Gazette. So if you do regularly attend Gazette offices, you've probably already done this. I'll hand over to Dinesh now, who will talk about the Saudi appeal process.
Thanks, Mark, and good morning, everyone. There has been not much tax updates this month, but some of our clients are asking a lot of questions and clarification on the assessment and appeal process. Even Gazette in the last few months has become aggressive in issuing a lot of assessments. So we thought it would be helpful to discuss the assessment and appeal procedures in detail. As you can see from the flow chart, there can be up to 5 parties involved in this entire appeal process. First, it starts with taxpayer, then Gazette, GSTC, ISC, and appeal committees. The process begins here with Gazette issuing an assessment to the taxpayer, and taxpayer has 60 days to respond to the assessment, either by accepting the assessment or filing an appeal to the assessment. In case where taxpayer accepts the assessment, they must settle the additional tax liability and the assessment case is closed. In case if taxpayer rejects or partially accepts the assessment, they need to pay the tax on the accepted items only. Again, the process is slightly different for VAT and Zakat, which we will come in the later slide. The important point here to note that your appeal will get rejected if the tax is not settled before filing an appeal on the accepted point. Then Gazette reviews the taxpayer's response, that is the objection, and then may issue the amended assessment. If the taxpayer accepts the amended assessment, then pay the additional due tax as per the amended assessment, the assessment case gets closed. If the taxpayer rejects the amended assessment, or if no response has been received from the Gazette within 90 days of filing an appeal, taxpayer can file an appeal with DVDRC, that's the new appeal committee, by registering their assessment case with GSTC, General Secretariat of Tax Committee, within 30 days of the elapse of 90 days. So this is the key point that business need to make sure and keep a track of the number of days as soon as they submit an objection with an Gazette, from the elapse of 90 days, and then within 30 days, they have to voluntarily register this case with GSTC in order to proceed with further appeal. And the important document that's required here, it's a power of attorney. Power of attorney is the name of a party who will represent the taxpayer at the committee, needs to be submitted while registering the assessment case with GSTC. Alternatively, simultaneously, taxpayer can approach their Gazette and request a meeting with ISC to negotiate a settlement to close the tax matter in a faster way. This ISC is basically an internal settlement committee. It's an independent committee from apart from this Gazette and the appeal committees. So they take up the cases for the taxpayer who want to resolve their tax matter at the faster pace. In case if the negotiation fails, a date for the hearing in front of the appeal committee will be set. So if taxpayer is not happy or not satisfied with the negotiation, they can walk away from ISC and they can continue their normal litigation process, and then the further hearing or resolution will be taken place. Prior to DVDSC hearing, taxpayer is required to settle the tax liability under dispute in full. This is the final appeal committee. DVDAC, that is Tax Violation Disputes Appeal Committee. When taxpayer move their objection to the final level of litigation process, the entire assessment liability needs to be settled, and then you proceed with your hearing. And whatever the decision that comes out of DVDAC, that should be the final decision, and taxpayer cannot appeal further. And there is one more important point which I would like to clarify here. Some of our clients are asking questions like the internal settlement committee decision is legally binding either on taxpayer or guesser. As I mentioned earlier, the ISA decision is not legally binding on either party. If taxpayer is not happy with the negotiation deal, they can walk away from it and they can follow the litigation process. There's another one complicated question which comes to the taxpayer mind while navigating this entire process. That is, what are the common issues faced by the taxpayers while navigating this process? In our experience, the oddest things that has been to ensure that POAs are issued correctly. There are several attestations required, and POA itself be prepared in a certain way, as in a legal manner where the objection committees will get accepted. We have seen number of appeals rejected at the first level because the POA has not been properly authenticated. So the taxpayer would be well advised to obtain legal opinion or speak to the Ministry of Justice in order to process their POA. Okay. So having looked at the assessment process here we are going to see the settlement procedure, which is important in the assessment process. Let's start with the important clarification. As I mentioned earlier, the taxpayer only have to settle the tax liability on the accepted points while filing an appeal. But the situation is slightly different for Zakat and VAT cases. For a Zakat-owned companies, they are required to settle a liability of between 10% and 20% of a disputed amount, or provide a bank guarantee for at least 50% of the full assessed amount at the time of filing an appeal. This provision was introduced in the new Zakat regulations that came out in 2019.
Thanks for that, Dinesh. So I just want to clarify for VAT, the person appealing in Saudi is required to settle or provide a bank guarantee for the full amount, including penalties. So that position is completely different from the other taxes. Having said that, we've successfully assisted clients recently with cancelling penalties under the tax amnesty that's currently ongoing, so that the payment of bank guarantee was only for the principal amount of the tax liability, so it excluded the penalties completely. Dinesh, I'm usually asked by clients what our experiences in relation to how successful appeals are generally. What are your thoughts and experiences about that?
It is an interesting question. We have worked with a number of clients on the assessment and appeal process. Some clients have accepted an assessment and some have approached the ISE and others have logged the appeal with the committees. What we have seen is that ISE is working particularly well. The client have been able to negotiate a settlement of up to 50% on the original assessment liability. And also in addition to that, there is currently a tax amnesty scheme which is going on till June 2021, which is also quite successful, where the client can drop off their objection or accept the assessment, and then the associated penalties will be waived. So this is a good initiative, and taxpayer can go back to their historical assessment position, because this would ultimately save a lot of amount on penalties if the assessment been issued like 4 or 5 years back. So this Gazette amnesty taxpayer can use till June 2021. And of course, during this COVID situation, we did not see many hearings taking place at the moment. So this might change once the situation gets improved. With this, I will pass over to Mark, who will talk through the updates for Bahrain.
Thanks, Dinesh. So a quick update on economic substance. So it's due at the end of this month. This is for the return for the calendar year ended 31 December 2020. So if you're carrying on a relevant activity, or if you really have no idea what economic substance is, you have a couple of weeks to look into it and see whether you need to submit a return. Those who submitted last year are probably already across it and know what they're doing, but returns are due at the end of this month. In local media, this is just kind of a general point to illustrate the fact that the tax evasion offences are being taken seriously. So there was instances of people being jailed in relation to not paying taxes and duties and excise taxes on the importation of certain types of goods. So they were jailed. It is indicating that the tax authority and Bahrain Customs is taking a stronger approach towards tax evasion. There was also news articles stating that the Bahrain Customs have processed over 40 million BD of customs duties and taxes through the e-payments gateway between August 2020 and December 2020 last year. Look, this is obviously a clear reflection now that customs and the Information e-Government Authority is starting to work together quite a lot more and having an exchange of information. So I guess we look forward to seeing more government departments integrating and things becoming more automated. Tariq?
Yeah, similar to Saudi, for non-residents that have incurred VAT in Bahrain during 2020, they also should review their eligibility claim of VAT refund. The deadline is the deadline is 31st of March, so that's only a few weeks away. It's 3 months earlier than Saudi. There are obviously specific conditions to meet, which are very similar to the Saudi guidelines. And that's that bit there. And another bit about the National Bureau for Revenue, they amended the import and export VAT guide to clarify import VAT overpayments at Bahrain Customs can now be claimed through the VAT returns. And for people who are not VAT registered, normally non-VAT registered importers, they can apply directly to the NBR. But more generally, businesses should really review their processes to ensure that import VAT is being recovered correctly. And it's important to ensure it matches what's held at Bahrain Customs, because if there's a mismatch, then it's probably going to lead to an audit at some point in the future. And also it appears that the NBR has noted instances where businesses are still submitting quarterly VAT returns, whereas their annual supplies are actually over 3 million dinar. Annual supplies are very different from annual turnover for financial statement purposes. So for VAT purposes, annual supplies will include stuff like supplies between related persons, your taxable supplies at 0%, taxable supplies at 5%, and also includes your imported services from overseas suppliers. So when you add them all together, if it goes over 3 million, then you should change your reporting cycle. Back over to you, Mark.
Thanks, Tariq. So turning now to the UAE, the FTA has deactivated the VAT form 301, which relates to paying import VAT. So they've deactivated as of February, the end of February, for all users that have a valid VAT registration and can therefore settle the import VAT liabilities via the VAT return. So the FTA is trying to clean up the process to I guess, further automate matters. Taxpayers that don't have a VAT registration, I guess they're probably not taxpayers, then entities that don't have a VAT registration should ensure that they're can still follow this process, but should really use a customs clearance agent in order to pay these liabilities. The FTA last month also released a press release speaking about the success of the ongoing tax inspections throughout 2020, finding over 190 million dirhams of tax liabilities. A lot of this was related to excise taxes and digital tax stamps. So I guess the cigarette packets that weren't holding the correct digital stamp. FTA has also released some comments on the sole establishment types of entities in the UAE. So they released a guide on this a bit earlier, I guess mid last year or so. And recently they've kind of spoken about it again. So it continues to be an issue. So sole establishments, they're a legal form of business which is 100% owned by a natural person. So this sole establishment doesn't have a separate legal personality that is independent of its owner. So in other words, a sole establishment and its owner are considered to be the same person for VAT. And they've just released some more guidance around this. It's really an issue for residents, for Emiratis that are operating businesses through their own name. Quickly on the OECD, so they've released a report, a first phase of a report regarding the mutual agreement procedures, so the MAP. What this is it's an agreed set of procedures between tax authorities of countries to improve the existing international tax dispute resolution procedure and to develop a supplementary dispute resolution mechanism. So look, it's a lot of words, but what essentially it's saying is when you have two countries with different tax systems, they have a treaty, a tax treaty. What happens if there's a dispute between the parties, which jurisdictions applies? And this mutual agreement procedures basically sets out the steps to take to, I guess, rectify these issues or address these concerns. Some of the examples of taxes covered by the MAP are TP issues involving cross-border transactions, withholding tax issues, income tax issues regarding permanent establishment, and tax issues relating to the actual application of any treaty anti-abuse provisions. So that's it for UAE. Looking now at Oman. So look, last month we spoke about Oman, obviously ramping up the VAT registrations and having set out a staggered registration timeframe. We've got the list of the staggered registration on the slide. There, unfortunately, hasn't been a lot of updates between now and last month. I would have expected to see the executive regulations by now, but they're still outstanding. So hopefully by next month, we have the regs to talk about. But just a bit of a recap, registration started from the 1st of February for an effective date of the 16th of April. That's only really for the largest taxpayers under this staggered system. So if you're operating in Oman, really have a look at your annual turnover to determine when you need to apply for registration so you don't miss it. If you're in the large category, you only have a few more days to make that application. So it's something to look at. And one update that I'm not sure we have on the slide is that the Oman Authority did in fact update their website for the VAT lookup tool. So you can now search for VAT registered companies. So that's it for Oman. We don't have any updates for Kuwait or Qatar this month, but for Kuwait, there was talk in the media around the expatriate remittance taxes. So this has been, I guess, kind of bandied about a bit for the last few years. And what's happening is just the Parliament's now kind of looking at it again, whether to tax the remittances from expats that are obviously going outside of the country. So trying to keep that money in the country. But yeah, that's really just in the news, and there's nothing really for Qatar at the moment either. That's the main, I guess, the content section of the webinar. We do have questions. I'll let Tariq maybe talk them through and we can answer them.
Yeah, so thanks. I've got a lot of questions today. So we'll go through them one by one. Someone's asked, can we approach ISC even if our appeal is registered with the GSTC? Dinesh, you're a good one to talk about that.
Yeah, as we discussed earlier, yes. ISC is an independent body and you can approach ISC during any time of your appeal process. Even if with Gazette or is with any of the appeal committee, there's no restriction. You can approach ISC during any time of your appeal process.
Cool, thanks for that, Dinesh. There's one about whether we need to pay the full tax liability whilst registering the case with GSTC. That's for Saudi. So I think for VAT, you need to pay the whole liability. But for zakat and other taxes, they're partial liability or sometimes no liability. Depends on the tax. Go to the next question. Can we escalate the case to the tax violations dispute appeal committee, even if it has been more than 6 months since resolution was issued, Dinesh?
No, you cannot escalate the case to a new appeal committee through GSTC if there has been 6 months since the resolution has been passed. So generally there will be 30 days will be provided for the taxpayer in order to register their case with GSTC. So if the taxpayer has not escalated within 30 days, then the assessment has become final and taxpayer have to settle the liability. This is very important that taxpayer need to ensure that the registered email address which is updated with GSTC at all time, and they need to monitor their correspondence at least once in a week to make sure like you're not missing out on any key emails from the Gazette or from the Appel Committee, which will eventually lead to rejection of your assessment.
Thanks for that, Dinesh. Okay, it's a question about second-hand goods. It's an interesting one. So someone selling second-hand goods which was sold before that was implemented in Bahrain, they're just wondering whether they can sell those goods under the profit margin scheme. Mark, what are your thoughts about that?
So the Bahraini rules for profit margin scheme, just to give a bit of a background for those that don't know. So profit margin scheme is available for second-hand goods that are sold, which basically means you can calculate the VAT on the margin between what you're selling the goods for and what you purchased them for. So you essentially charge VAT or account for that at a lower rate, not rate, but on a low amount than what you're selling the goods for. So as to whether you can apply the profit margin scheme to goods acquired before VAT implementation, the answer is no, because the goods need to have gone through the VAT life cycle. What we mean by that is through the VAT system, have VAT charged on the goods and embedded in the goods before the profit margin scheme can apply. So the answer is no.
Thanks, Mark. There's one about the VAT treatment for recharges of labor costs, such as LMRA fees. How does that work? The recharge of costs, should they be taxed or are they out of scope?
This one's a tricky one. So you've got to look at the reimbursement versus disbursement rules, and which really come down to who is incurring the cost. So for LMRA fees, normally they're in a specific person's name or a specific company's name. So say, for example, if Keypoint's paying for LMRA fees on behalf of a client, LMRA is still billing the client. So whatever Keypoint pays is just a disbursement. So when Keypoint goes and recovers those fees from the client, then there will be no VAT on that. It's just a pure disbursement. But look, anything with recharge of costs and statutory costs or any form of services, you really need to look at it in detail.
Thanks for that, Mark. There's one about I've asked a supplier in Japan to ship goods from Japan directly to our customer in Kenya. Can I zero rate the supply? This supply of goods is probably going to be outside the scope of that because the goods are not leaving Bahrain. They never enter Bahrain. So this type of supply will be outside the scope of that. The next one, I'm a Bahrain-based motor dealer providing promotional services in relation to goods imported from a manufacturer located outside of Bahrain. The fee for providing such promotional activities is reduced from the value of goods imported from the supplier. Is VAT applicable on the fee charged for such promotional activities? So this one is essentially two supplies. So there's an overseas manufacturer making a supply of goods to the local Bahraini car dealer. That's a separate supply. Then there's a second supply from the local motor dealer to the overseas manufacturer. So just because they net off the amounts, it doesn't mean there's not a requirement to account for VAT from both sides. The local supplier will still need to work out the amount of their supply and report this on the VAT return. It may be subject to tax at 5%. It may not be. That would obviously depend on whether it meets export of services conditions. But essentially, just because you net off something, it doesn't withdraw a liability from the person receiving services not to report a transaction. Okay, there's a question. In case of payment of VAT in Bahrain's customs department, are we eligible to claim the refund as a non-resident company? So I think we covered this in the slide. So if you're not a resident in Bahrain or Saudi, and you incur costs, which attract VAT for goods or services there, you probably can make a refund claim, but there's obviously conditions to meet. And obviously for Bahrain, there's a deadline end of this month. And for Saudi, the deadline's end of June. UAE, I think, is September. So you can claim it, but you just have to meet the conditions. Despite repeated requests, my supplier is not issuing fully compliant tax invoices. This one's an ongoing one. Some suppliers, the problem is that their systems are so big and the approval process is so, long-winded before they can make changes. So you probably will not get a revised tax invoice. But look, if the invoice is 99% compliance and there's a minor anomaly or something very insignificant is missing, I've not seen the NBR or Gazette make an issue out of it. So it's probably just taking a business decision, what's an acceptable level, of requirements that are met. So for example, everything's there, but I don't know, SPC or WLL are not there, then I would personally probably still claim that, even though it's not strictly correct. But otherwise, you'd keep going back to your supplier and asking for invoices. It would not be commercially possible. VAT profile update, is it a yearly requirement even there is no change in the CR activity?
So I think what this question is getting at is the NBR in Bahrain. So what we've seen a lot is getting emails from the NBR or letters from the NBR saying that you're required to update your VAT online profile. This has happened a lot with the SPCs changing to WLLs. So we've seen that. So when clients have updated those details, the NBR has then asked for all the other details to be updated. So if you recall, when you registered for VAT in Bahrain, you would have put your future expected sales and your previous sales and things like that. What they're asking you is to update those details as well. So as to whether it's a yearly requirement, to be honest, I'm not sure. There's nothing in there's a requirement to keep the NBR updated with details, but as to whether it covers your historical sales or anything like that, I would say it doesn't, but ultimately you're being asked to do it. So I think you just need to comply. It's one of those things. And it kind of follows on from that point we had in the webinar around changing the VAT return cycle. So we have seen, following on from this, is that if you've got your sales that maybe when you registered, you said expected sales would be, I don't know, 1 million or something, but your lodgement on your VAT returns is 4 million, then you will start getting emails saying you need to report on a monthly basis.
Thanks, Mark. So just give me 1 second. It's just a bit stuck. Okay. I'm still confused on the difference between an adjustment and an apportionment.
Okay. So this is talking about VAT recovery. And I guess the confusion arises from the VAT return itself, right? There's a column that says adjustment dash apportionment, I think. Let's start with adjustment. Adjustment is when you've made a mistake. You've reported something incorrectly. You've realized in a later tax period. So now you need to adjust that earlier tax period to correct that error or mistake. There's various different ways to correct errors and mistakes. You might not need to amend the earlier return, but generally that's what an adjustment's talking about. Apportionment, on the other hand, is about input tax recovery. So if you're buying goods and services, being charged VAT, paying VAT to your suppliers, can you recover that on your purchase? And that's going to go to whether you make totally taxable supplies or whether you have exempt supplies as well. So there will be an apportionment that needs to be made based on what is my purchase related to, the taxable side of things or the exempt side of things, or is it kind of both? And therefore I need to apportion. So that's really what that's about.
Thanks, Mark. There's one on cancellation fees. Is VAT applicable on cancellation fees? So with cancellation fees, it really depends if you do anything and still keep the money. So you go to, let's say example, you go to a hotel, you pay for a hotel stay and then you decide to cancel it. But when you cancel it, the hotel still keeps your money and still keeps a room available for you should you decide to turn up. In that case, if they keep the money, they're still doing something in return for that money, i.e. keeping your room available. In that case, it's probably going to be taxable. Whereas if they're just penalized and keep your money and then the room's available for someone else to book, it's probably going to be outside the scope of that. But penalty, I mean, penalization or keeping, cancellation sort of fees or money, it's not straightforward. It really needs to be looked at, because even in EU countries, there's a lot of case law about these sort of things, and there's some rule changes that happened recently with cancellation fees. So it's just something to think about. There's a question about sale of goods from Oman Sohad free zone to Qatar. Should we include them in the taxable turnover calculation for VAT registration application? Look, we'll have to check into that. I'm not sure. It's something we'd have to just have a read up on and get back.
Yeah, look, I think these kind of detailed supplies through free zones in Oman will probably be covered in the regulations, which are yet to be released. Yeah, we'll definitely get back to you on that one anyway.
Suppliers charging me VAT on warehouse rental, even though I understand it's exempt. Is that correct? Well, it may be that you're not allocated specific space in the warehouse, in which case the VAT treatments will probably be right. But if your supplier is allocating a specific space in a warehouse, then that really probably is likely to be exempt. So it might be worth checking with them on how they've worked out the VAT treatment. Okay. I've got a few questions left. If an agreement with the supplier is old and not updated with a VAT clause, however, his invoice charges VAT, are we required or eligible to pay VAT?
Okay, so I guess the starting point on this is just to note that VAT will apply to the actual supply. So whatever you're purchasing or supplying, that's when VAT you need to look at the VAT rules. So if you've got a contract or you don't have a contract, you could still be charged VAT. So what the contract does is, if it has a VAT clause, or let's say it doesn't have a VAT clause, then the assumption is that any payments under that contract are treated as inclusive of VAT, if I recall correctly. So what that means is, whatever you have to pay your supplier, the amount you agreed in the contract is the amount inclusive of that. You don't need to pay him any more than that. Obviously, there's commercial ramifications of that. So I guess the point to take away is, it doesn't mean you need to pay that or you don't need to pay that. It's more about how much VAT you have to pay.
Thanks, Mark. And the last one, Mark, is received a tax invoice with a different exchange rate from the rate allowed by the NBR, and the supplier refuses to change the rate. What rate should I claim suppliers or allowed by the NBR? This is an ongoing one as well. So sometimes you'll have a purchase and the rate that's programmed into your supply system is not the CBB rate. Strictly speaking, it should be the CBB rate, but again, it's one of them commercial reasons where sometimes suppliers are not able to do that. And when you do account for the VAT, you've got to really look at the invoice and work out whether there is a Bahraini dinar equivalent, because if there's an exchange rate, if you're saying there's an exchange rate, that's probably likely to be a Bahraini dinar equivalent. And then you would just claim that Bahraini dinar equivalent, but we'll send a comment around that with our Q&A answers.
Cool.
So I think that's it. That's the end of the questions.
Yeah, no, look, I thank you everyone for dialing in. We obviously love these questions. In the next webinar, we have this every month, so we'll keep it coming. You will see an email from us probably by the end of tomorrow with the slides as well as the answers to the questions. And obviously we have our tax flash emails that come out every Thursday. For those that have completed our survey for VAT, or even for those that didn't, you will receive a report on the findings from our survey this week. So we're just kind of finalizing that report, which just goes through and shows how certain taxpayers have been dealing with VAT since it's been implemented, some issues identified and other things like that. So look out for that. You should receive an email over the coming days. But yeah, look, that's it from us. Thank you for dialing in, and hope you have a good rest of the day.